Welcome to this webinar. We will present our fund, Katch Real Estate Lending. It's a fund that is dedicated to bridge loan strategy and 100% invested in the UK. We have Priyesh Patel on the webinar as well, which is our portfolio manager based in London. And we have Laurent, the chairman of Katch, also based in London in the same office as Priyesh. The idea of the webinar is to introduce you to this fund that has actually 5 months of track record now and a size of about $20 million. We will explain what are bridge loans, why we believe that the UK market is the best market in the world to do this, to run this strategy. We'll give you an introduction to the team that manage this strategy, and we're also gonna give you an overview of the current portfolio composition. So let's start. So what are bridge loans? A bridge loan, it's a short-term loan that we provide to someone until he can secure a permanent financing. They tend to be very short-term. Usually we talk about a duration of 1 year. They have a relatively high interest rate. We're talking about an interest rate in average of 1% per month, which is about 12% annualized. And we have all the time very strong collateral. In our case, we only have real estate based in the UK as collateral. So if we take an example, we have an English real estate developer. His name is James. He has been in this industry for the last 20 years. He has a very strong track record. He's done at least 15 projects with a lot of success. And he's at an auction in the UK to buy a pub. So there is a pub that is worth £1 million that he buys at an auction. The day of the auction, he needs to put down as a deposit 10% of the value of the property. So he put 100K right away the same day. And now he has 28 days to find the residual missing, the 900K that are missing. So he knows that it's impossible to get a traditional loan with a bank in 28 days. So what he's gonna do, he's gonna ask for a bridge loan to a fund like us to get the financing. As a fund manager, Priyesh will require him to put at least 35% of the value in property in equity. So he's gonna put 350K with his own equity, and we will finance the difference, the 650K missing. We have now a loan, let's say over a period of 6 months, of 650K at an interest rate of 1% per month. And in collateral, we have a pub that is, the value is about £1 million. That means that we have what we call a loan to value of 65%. The value of the loan is 650K. The value of the collateral is 1 million. We have an LTV of 65%, meaning that we have a lot of protection for that particular loan over this period of 6 months. So why do we believe that the UK market is the best market in the world to run such a strategy? First, it's the biggest market by far in Europe. We had about £20 billion of origination of bridge loan in 2018. That's 3 times more than the German market, and that's more than all continental Europe combined. The UK market also has a very strong legal system. It's probably the best one in Europe by far. It takes only 2 weeks to size a collateral in case of a default, when it takes more than 2 years in France, for instance. And we believe that with the US market, this is the market that protects the most the lenders in the world. There is also a very good real estate auction market in the UK that works extremely well. In case we need to size the collateral and we need to resell it, we can do that, we believe, in about 3 months. And the discount on the auction market is only 5%, which is very low. It is a lot higher in other markets in the world. The reason why there are so many opportunities in the UK market is because the banks, the traditional banks, do not want to lend money for loans lower than £5 million for a period lower than 9 months. So this is our niche. This is where the opportunities are. We focus on loans lower than £5 million with a duration lower than 1 year in average. You can see on this slide that actually banks retreated the most in the UK, and this is why we're actually 82% of the small and medium companies do not go to banks anymore for lending activity. We also believe that prices will remain very stable in the real estate markets in the UK. The reason for that is that we have a big deficit of housing. We estimate that the current deficit of housing is about 4 million homes in the UK. The reason is that the population grew a lot over the last 10 years, and the level of construction didn't grow at the same pace. So that's, as a result, we have a big deficit, especially in the periphery of London, which is also the focus of our fund. We cannot talk about the UK without talking about Brexit, obviously. Brexit for us, it's an opportunity and it's not a threat. I repeat, Brexit for us is a big opportunity, because if we have a Brexit, then banks will lend even less to real estate developers, and this is so that will increase our capacity in this particular market. We also believe that prices are already reflected Brexit. We can see that actually over the last 12 months, the London market, the high-end market, decreased in value by about 5%, when actually prices continue to grow, to increase in the other regions. Our focus again is the London middle market with the periphery, and we do not foresee any corrections on those regions. When we look at the evolution of prices over the last 15 years, we can see that the biggest correction we have seen was a correction of about 20% during the last financial crisis in 2008. So if we take that in consideration and we consider that the worst case scenario for us is actually a drop of 20%, that means that we need to have at least an LTV value of about 83%. The current LTV of our portfolio is 67%. That means that we can have a correction in the market of 35%, and that will not affect the NAV, the net asset value of our fund. This is 67% is a lot of protections, and that's one of the requirements that we have, not to go above 70% of LTV for any single loan. I'm going to let Priyesh now introduce his team and talk a little bit more about the current composition of our portfolio of loans. Priyesh?
Thank you, Stephane. Welcome everyone. My name is Priyesh Patel. I'm the portfolio manager here, joining Katch to run this product. I have over 20 years experience, and joining me alongside me is a team with Amar as well, whose photos there, who is very well experienced in dealing with the originating infrastructure in the market. particularly all the brokers and property developers who require this kind of financing. We've been successfully managing and implementing deals and monitoring them over well, personally myself over 20 years, but as a collective over 3 years. And we have not experienced any negative months over this period of uncertainty as Brexit has been prevailing, and no defaults even through that period. I just want to move over to the next slide, Stephane. Great, thank you. Just we'll touch a little bit on the fundamentals of how we approach a deal. And as the slide shows, it's very important to us to do our correct due diligence on every deal before we allocate any capital to the loan. And they're largely broken down to 3 areas. Is an initial appraisal of the property, and then there's initial appraisal of the borrower, and then the feasibility of the exit over the term of the loan. Now, the appraisal of the property is joined with our own expertise, but we also employ some of the best experts in valuations in the UK, surveyors that will go and independently value these properties for us to give us a range of valuations, from stressed valuations to market valuations, and we will use our judgment to know which one of those valuations we use in our LTV ratios, which Stephane touched on earlier. Complementing that is the background check of the actual borrower and a full credit check, AML check, KYC check, to ensure they are creditworthy. And perhaps one of the most important elements is the viability of the exit of each of our loans. If they are going to sell the property, is the market in the area priced correctly? Will there be enough in the sale price to redeem our facility? Is something we'd look at great length. In addition, if we have a developer that's looking to exit our facility into another facility, such as a development facility, we would then look at the viability of that as well. But those 3 main metrics will be very critical in our due diligence for every loan, and they underpin our fundamentals. As you can see in this slide, we are showing just an overview of our current portfolio. Since this, I think we're slightly higher than $15 million as target assets under management. We target net return net of fees of 8%, and across on the left you can see that our loan size is approaching £500,000 sterling. We've touched on the LTVs at 67%, and the short term is all sub 12 months at the moment, and weighted average at 10.3, and a gross return rate of 11.5%. As you can see on the right hand side, we have a target return for the fund of 8% net of fees, but we focus on first lien projects with very sub 12-month maturities in regional cities where we are experiencing chronic housing shortage, but growth in population and growth in a population that is looking for first-time buyer metrics, as well as the metrics across the more mature side of the property market. As we've already touched on, the collateral and the exit strategy is very important to us. We are not employing any leverage, and we would be offering quarterly liquidity on this product as well. At the bottom, we can see that our asset allocation is quite well balanced between residential portfolio, commercial, and mixed use. We have a strong focus on first lien in our portfolio, and we have sufficient comfort in our LTVs. Yeah. As opposed to regional focus, the yellow at the bottom determines where our capital is deployed. We are focusing strongly on deploying in other areas within the UK as well, such as the northwest and northeast, as they have by no means any less good metrics than those areas. But within Greater London, we do have a definite focus on non-prime London, which is, as anyone that's been to London will know, is in zone categories. So zone 1 and 2 would definitely be less of a focus. That is not to say we do not allocate in there. We are very particular regarding areas and types of properties in those areas that would still have a good risk-adjusted return. But as the slide says, we focus on regions with housing deficits, good metrics, good levels of employment and job opportunities coming there, as more and more companies are now devolving from London to set up headquarters up and down the country. And which goes again to what Stephane was saying about the potential of Brexit being more of an opportunity than a threat in this area. So just to run through a few examples, and they're both at the different ends of the scale. On the first example is a commercial property in the Midlands in a city called Derby. It was a developer who had acquired the site and had successfully received planning from the local council to convert it into residential units. As you can see here, we granted a loan. It was valued at 500,000 sterling. We granted a gross loan at 375k on a first lien. The LTV was 75%. It's for sub 12 months, 11 months at a rate of kind of gross interest rate 11.35%, based in the Midlands. Now, this was a small development, and as you can see by reflection, it's one of our smaller loans. And as when we look at the deals of this caliber, we would always look at the feasibility of what they are building, how long it's going to take them to build, and the market in the residential space in that area to feasibly give us an exit. On the right-hand side is one of our larger projects. It's a commercial property, which is was previously a golf course, which has now been reconfigured to be a wedding venue, wedding receptions and venue setup. It's a facility of over 3 million sterling. This time the LTVs are lower at 65%. Based in Greater London, but in Outer London, in a very prime area, and the actual borrower is a very experienced borrower who knows the banqueting industry very well, and they were looking to expand to a new facility. And within that, we would be looking at their experience in this sector, along with their personal guarantees, before we would furnish a loan of 3.1 million in that space. But those give you a flavor of two different ends of the spectrum of the loans we are currently writing into the fund.
So as you can see on this slide, you get the monthly historical return of the fund. This particular fund, the SICAV, the SICAV from Luxembourg, was actually launched in August 2019. So it starts from this performance of 1.04. The track record that we use prior to that date was the track record of Priyesh, that the strategy that he was running with another firm before, with exactly the same criteria, target in terms of LTV about around 70%, and with the same focus on the regions in the UK. Regarding our fund, so it's a SICAV RIFE from Luxembourg. Our IEFM is Fuchs Asset Management. That is the official asset manager for the fund based in Luxembourg. They also ran a due diligence on all the loans that we provide. So our investors get kind of a double due diligence that is operated. Our administrator is Cycle Partners, also based in Luxembourg. Our auditor is KPMG. And finally, our custodian is Banque de Patrimoine Privé. As Priyesh said, our target return is 8% net for investors in dollars. And the liquidity is quarterly with 45 days notice. Our fund is available on all the mutual fund platforms, such as Allfunds, Fundsettle, Clearstream, and we're also available on all the main private banks such as UBS, Credit Suisse, Julius Baer, Safra. In terms of share classes, we offer 9 share classes. We have 3 currencies: British pounds, US dollars, and euros. We have share class that are with accumulations, other with distributions. In terms of distribution, we distribute a dividend of 1.5% in dollars every quarter, which is 6% annualized. And in euros, we provide a dividend of 1% per quarter, which is 4% annualized. Thank you very much for your attention. We're gonna take now some questions, and I offer our audience to write their questions on the Q&A button at the bottom of the screen. I guess we don't have any questions today. So I would like to thank you again for listening to this webinar. We will organize our next webinar in about 2 months' time. We will give you again an overview of the compositions of the portfolio. Thank you very much.